In Malaysia, there is no common definition of SMEs. Instead, the definition varies based on two main criteria, which is first is the number of employees and the second one is the annual sales turnover. These criteria are then applied across three major sectors, ensuring comprehensive coverage of economic activities. The sectors in focus include primary agriculture, manufacturing, and services. But for our presentation, I'll focus on manufacturing and services. The specific criteria for manufacturing are as follows. Starting with micro enterprises have less than 5 employees or an annual turnover of less than Rm 300,000. Small enterprises have 5 to less than 75 employees or an annual turnover between Rm 300,000 to less than Rm 15 million. And the last one is medium enterprises have 75 to 200 employees or an annual turnover between 15 million to Rm 50 million. Now we're moving on to the next sector, which is services and other sectors. The specific criteria starting with micro enterprises have less than 5 employees or annual turnover of less than Rm 300,000. Small enterprises are businesses with 5 to less than 30 employees or an annual turnover between Rm 300,000 to less than Rm 3 million. And medium enterprises are businesses with 30 to 75 employees or an annual turnover between Rm 3 million to 20 million. This classification system helps standardize SMEs recognition across the manufacturing and services sectors. These clear definitions assist policymakers, businesses, and stakeholders in identifying and supporting SMEs effectively.
Assalamualaikum, I'm NADIYATUL AMIRAH. We'll discuss the need for financing among small and medium enterprises, SMEs, that focusing on three main purposes highlighted by Bank Negara Malaysia. According to their findings, the primary need for financing among SMEs were for the purchase of asset 23%, working capital 22%, and starting a new business 19%. Let me explain each of these in more detail. First, purchase new asset. SME needs financing to purchase new assets such as building, property, machinery and equipment because these assets are fundamental to running the business efficiently, and it involves large costs that many small businesses cannot afford without external financing. These assets are important for productions because it enables businesses to operate efficiently and maintain their product quality. Without the proper asset, it will make SMEs struggle to meet customer demand, resulting in delay and reduced ability to scale their operations. Second, working capital. SMEs need financing for working capital to ensure they have sufficient funds to cover day-to-day operations expenses, such as paying salaries, purchase inventory, and covering utility bills. Without enough working capital, businesses may struggle to keep operations running smoothly. Having working capital financing gives SMEs the flexibility to handle unexpected costs or tough times like seasonal downturns or emergencies without worrying about running out of money. Lastly, starting a new business. One of the main reasons SME needs financing when starting a new business is to cover the large cost of establish their physical infrastructure and operation. The startup expenses often require large upfront costs that most entrepreneurs cannot afford without external financing support. By using financing, it allows SMEs to finance their expenses over time and can avoid using their personal savings or rely entirely on family and friends for financial support.
We move to the financing problem. Usually, SMEs are facing a high cost of financing. This is because SME are frequently viewed by the lenders as a bit more risky than bigger, more established business. A smaller asset base, a shorter operational history, and a greater value rate are some of the causes of this view. Lender rise interest rates as a result to offset the additional risks. Secondly, cash flow management. SME frequently struggle with maintaining a steady cash flow due to delayed payment from customers, unforeseen expenses, or inadequate cash flow forecasting. This can make it difficult to cover operational costs or invest in new opportunities. Furthermore, because of a lack of working capital, Lack of working capital is a significant challenge for SMEs. This is because SMEs frequently have a client payment delays, which can cause cash flow issues. Payment period for a larger client may be longer, often reaching 60 or 60 days. As a result of this delay, SME may not have enough cash of hand to pay for daily operations costs, including utilities, rents, and salaries. Lastly, because of the difficulty securing financing, SME often face a significant challenges when trying to secure loans due to the loans applications procedure may be complicated and time-consuming, which is especially difficult for SME with limited administrative resources. Lenders sometimes have a high qualifying condition that SMEs may find difficult to achieve, such as a minimum revenue level or profitability standards. Firstly, by government and policy intervention. Through Credit Guarantee Scheme or CGS are programs where the government or designated agency provide a guarantee to lenders, such as bank for a portion of the loan amount extended to SME. This reduces the risk for the lenders, encouraging them to provide loans to businesses that might otherwise be considered too risky. Plus, SME must meet a certain criteria to qualify for a scheme, such as being within a specific industry or having a viable business plan, or meeting certain financial health indicators. So, what to benefit under CGS? Firstly, can increase the access to credit, which is by reducing the risk for the lenders. CGS make it easier for SME to obtain loans even if they lack of substantial collateral or have a limited credit history. Second, can lower interest rates. With the reduced risk, lender may offer more favorable terms, including lower the interest rate. Third, encourage business growth, which is access to credit allows SME to invest in expansions, new projects, and innovations, driving economic growth. Then, under subsidized loan program, which is involve the government providing loans to SME at below market interest rates. These programs are designed to make borrowing more affordable and accessible for small businesses. This program also often targets specific sector, regions, or types of the business that are deemed critical for economic development or that face particular challenges in accessing financing. So, for the benefit, it will encourage investment, which is the affordable financing encourages SME to invest in growth opportunities such as purchasing new equipment, expanded operations, or entering new markets. So, we can also measure to ease the financing problem by technological integrations. In the digital age, the integration of the technology into business operation is essential for SME to remain competitive and efficient. Digital tools and platforms offer numerous benefits, from automating routine tasks to providing valuable insight that drive strategic decision-making. So, under technological integration, we have digital tools. By digitizing business operations, SME can automate processes such as accounting, inventory management, and customer relationship management. This reduces operational costs and improve efficiency, allowing SMEs to allocate resources more effectively. As a result, the business can improve the efficiency and cost can be reduction. And under technological integration, we have e-commerce support. So, e-commerce support is a platform can help SME reduce operational costs by automating various processes. For example, automate inventory system can minimize the need for the manual stock check and reducing labor costs and improving accuracy. As a result, it can reduce the operational costs. Other than that, e-commerce platforms often provide tools for the better cash flow management, such as real-time sales tracking and automate invoicing. These tools help SME manage their finance more effectively, ensuring they have the necessary funds to operate smoothly, and as a result, it will improve their cash flow management. For example, e-commerce support in Malaysia is like Zalora, StopHub, and others.
I will explain two more measures to ease financing problem. The third one is leveraging fintech for financial inclusion. This measure addresses financing challenges by using innovative financial technology solutions to provide more inclusive tools. Fintech platforms such as peer-to-peer lending and equity crowdfunding offer alternative financing options that cater to SMEs often excluded by traditional banks. This helps SMEs to overcome barriers to financing while supporting their growth and innovations. Lastly, developing data infrastructure. The lack of data and information about SMEs often limit their access to financing and resulting in higher borrowing costs. By enhancing data infrastructure, the government can improve transparency and credit assessment using tools like public database and digital initiatives like digital ID and e-invoicing. Policymakers can reduce information asymmetry and improve lender confidence in SMEs. This not only diversifying funding options but also lower the cost of financing.
Main of source will come from the owner itself or family, even friends. So investor from family and friends often prioritize helping you succeed rather than just earning money. Because they care about your success on a personal level, they may be willing to invest at lower returns than traditional investors. Their motivation is often mixed with wanting to support your dreams, strengthen relationships, or be part of something meaningful. So financial gain is not always their main goal. So this can make them more flexible about how much profit they need from the investment, especially if they believe in your vision or business. Source of financing may come from bank because they might be help a business by offering a short-term overdraft or a long-term loan, especially if it is secured by valuable asset like property or land. So however, getting medium-term loans, which are in between short and long-term loans, is often harder for small and medium-sized businesses, SMEs, because banks are usually very careful about lending, because if one loan fails, it takes many successful loans to make up for that loss. Thus, because of this cautious approach, many SMEs end up using short-term finance, like an overdraft, to pay for assets they need for a longer time. So this mismatch between short-term financing and long-term needs is called the maturity gap. So ideally, the financing term, how long the loan lasts, should match the life of the asset, but this is not always possible for SMEs. The SMEs also can get source of their financing by government, which is in the Malaysian government itself offers various grants and loans to support SMEs in the country. So these programs encourage entrepreneurship, create job opportunities and stimulate economic growth. For example, the Market Development Grant, which is MDG, is available through Matrit, which provides reimbursable grants up to 300,000 for a lifetime. So you can use this grant to procure the necessary equipment to participate in Malaysian international trade fairs and export your goods to overseas. Alright, to wrap up, or lastly, from business angle, there is a wealthy individual that willing to take the risk of investing in SMEs. So one limitation is that these individuals are not common and are very often quite particular about what they are prepared to invest in. So once a business angel is interested, they can become very useful to the SME, as they will often have great business acumen themselves and are likely to have many useful contacts.